You look around and everything feels like it's on fire. Wars are dragging on, your rent went up again, groceries cost more every trip, and inflation is still eating into whatever raise you got. And yet, the stock market just keeps climbing. The S&P 500 closed at 6,890.89 on October 29th, 2025, and set 57 new all-time highs in 2024 alone. That's more than one per week. So you ask yourself, is the stock market a casino? A random number generator with no connection to your life? It's a fair question, but the answer is no. It's not a casino. It's worse than that because it looks like a casino, feels like a casino, but it's actually a machine with a specific set of rules that most people don't understand. And that's where the problem starts. The big mistake people make is treating the stock market like a mirror of the economy. Good economy, stocks go up. Bad economy, stocks go down. But that's never been true, and it's especially not true now. The market is forward-looking. It prices in future profits, not your current rent check. It reacts to interest rates, which affect how much those future profits are worth today. It responds to money flows, as trillions of dollars slosh between asset classes. And it's increasingly driven by forced trading algorithms that react in milliseconds, not humans weighing the news over coffee. Those four drivers, future profits, interest rates, money flows, and forced trading, are the real levers behind every record high you see. And they're all being pulled right now in ways that benefit a very specific group of people. The market doesn't care about your grocery bill. It cares about whether the next quarter's earnings will beat expectations. It cares about the fact that the Federal Reserve held rates at 4.25 to 4.5% in July of 2025. Still high by recent standards, but not high enough to kill the party. S, stock volume. That's machines making decisions in milliseconds, not humans weighing the news. But before we pull back the curtain on the machinery, let's look at who actually owns this market. Because the answer to that question tells you everything about why the headlines don't match your reality. If you want to understand the machinery behind the headlines, hit that subscribe button. We're only scratching the surface. Let's look at the index itself. The S&P 500 is supposed to be a snapshot of the broader market. But in late 2025, the top 10 companies in that index accounted for about 41% of its total weight. That's more than double what it was in 2015, when it was around 19%. The last time we saw this level of concentration was in 1932, during the Great Depression. So when the S&P 500 hits a record high, it's not because 500 companies are all thriving. It's because a handful of giants are pulling the entire index higher. Specifically, NVIDIA alone makes up about 7.5% of the index. Microsoft is around 6.7%. Apple is about 5.6%. Those three companies together represent nearly 20% of the entire S&P 500. So your 401k's performance is largely tied to the fortunes of three tech stocks. If they sneeze, your retirement account catches a cold. Now compare that to the real economy. S hold about 31.8% of total household net worth. The bottom 50% combined hold just over 4%. That's not an accident. That's the result of decades of policy that favors asset owners. And the stock market record highs are a scoreboard for that asset owning class, not a reflection of broad economic health. The index's concentration means that the gains are funneled upward, and the people who benefit are the ones who already own the most. This concentration has a mechanical effect. More than $40 out of every $100 invested in an S&P 500 index fund flows into just those 10 companies. That's because the index is weighted by market capitalization. The bigger a company gets, the more money flows into it. It's a feedback loop that inflates the largest stocks regardless of the broader economic reality. So when you see a record high, it's not a signal that everything is fine. It's a signal that the machine is working exactly as designed, funneling wealth upward. You might think that owning an index fund is safe diversification, but when the index is 41% in 10 stocks, you're not diversified. You're concentrated. And that concentration risk is something most people don't consider. They hear S&P 500 and think it's a broad market fund, but it's increasingly a bet on the tech sector. If the fortunes of NVIDIA, Microsoft, and Apple turn, the entire index turns with them. That's not a diversified portfolio. That's a high-stakes gamble on a few companies. And here's what that means for the average person. Only about 62% of Americans own any stock at all. Only 35% hold stocks outside a retirement account. So the majority of the population is not participating in these record highs. The wealth is being generated for the people who already have the most, and the rest are watching from the sidelines. The bottom 50% of households hold just over 4% of total net worth. That's not a rounding error, it's a structural feature. So if the market is so concentrated, what drives it? It's not just current earnings, it's the expectation of future profits. The market is betting that these giant companies will keep growing their earnings, even if the rest of the economy struggles. That's why you can have a record high while consumer confidence is slipping. The market is looking forward, not backward. But that forward-looking bet is heavily weighted toward a few companies. And to understand how that plays out, you have to look at how interest rates, money flows, and forced trading come into the picture. Let's start with interest rates, because they're the most misunderstood piece of the puzzle. You already know the Fed held the federal funds rate at 4.25 to 4.5% in July of 2025. But the level itself is not the story. What matters is whether rates are higher or lower than what the market already baked into its models. And the market had been pricing in those rate hikes for months. So when the Fed held steady, it wasn't a shock. It was confirmation, stability. And stability is a green light for stocks. Here's the mechanism. Future earnings are worth more today when interest rates are lower because you discount them less. Even at 4.5%, if you believe the tech giants can grow earnings at double-digit rates, the math still favors stocks over bonds. The alternative is a treasury bond yielding around 4%. That's not a compelling trade when you're betting on NVIDIA's next chip cycle. So the rate environment is supportive, not restrictive. It's not the 0% party of 2020, but it's not the 15% nightmare of 1980 either. It's a Goldilocks zone for the forward-looking machine. Now the third driver, money flows. Where's the cash moving right now? You've got a new wave of retail investors entering the market. As of mid-2025, households with below median incomes were transferring money into investment accounts at 5 times the rate they did between 2010 and 2015. That's a meaningful shift in behavior. It's not enough to move the needle against institutional money, but it adds a layer of demand that wasn't there a decade ago, and that demand is sticky. People who start investing during a bull market tend to keep buying on dips. They're not selling into weakness. They're adding. So you have a permanent bid from a demographic that previously sat on the sidelines. Combine that with the passive flows we already discussed, and you get a market where money is pouring in from multiple directions, regardless of the headlines. The fourth driver is forced trading. And this is where the market gets weird. You've heard that algorithms drive most of the volume. But here's what that means in practice. These machines use natural language processing to scan news headlines, earnings call transcripts, and Fed statements in milliseconds. They can pick up a sentence about inflation or a trade deal faster than you can finish reading it, but they don't understand what they're reading. They don't know that a war is tragic or that a trade deal is fragile. They just pattern match keywords and execute. So when a headline says unemployment ticked up but less than feared, the machine sees less bad than expected and buys. That's the less bad than feared effect. When expectations are already rock bottom, any improvement triggers a rally. And that's been happening repeatedly. The economy isn't booming, but it's not collapsing either. The machines see a reason to buy on every marginally positive data point. That creates a self-fulfilling cycle where even mediocre news gets interpreted as good news. You combine all 4 drivers and you get a market that keeps climbing even as the world feels chaotic. But here's the part that should make you uncomfortable. This isn't a healthy market. It's a market propped up by mechanical flows, algorithmic herding, and a bet that a few companies will dominate forever. And that bet is becoming more fragile by the day. But there's a darker reason stocks keep rising, and it has to do with the government's own spending. Let's look at that spending. S. National debt has surpassed $39.7 trillion. That's a number so abstract, it might as well be a phone number from another galaxy. But the interest payments on that debt are very real. The Treasury is writing checks for roughly $3 billion every single day. That's over $1.2 trillion a year flowing out of the government. And when you ask who's on the receiving end, the answer is not surprising. Bondholders, which are overwhelmingly wealthy individuals, pension funds, and institutional investors. The same people who already own the bulk of the stock market. So you have this quiet, mechanical cycle. The government borrows by issuing bonds, pays interest on those bonds, and that interest lands in the portfolios of people who are already sitting on large piles of capital. Those people take that interest income and reinvest it. A big chunk of it goes right back into equities. The government's own borrowing costs are creating a permanent demand for stocks. It's not a conspiracy, it's arithmetic. Every $3 billion a day is a feeding tube pumping cash into financial assets. The more the government runs a deficit, the more money flows to asset holders and the more the stock market benefits. The people who don't own assets get nothing from that cycle. You might think the deficit is a drag on the economy, but in the short term, it's a tailwind for the portfolios of the wealthy. The interest payments are recycled into the same market that's setting records. The machine feeds itself. Now, you've probably heard the claim that the pandemic triggered the biggest wealth transfer in history. That's a catchy phrase, but it's not what the data shows. The Federal Reserve's numbers tell a more modest story. The top 1%'s share of net worth increased by about 2 percentage points from early 2020 to late 2025. That's a meaningful increase, but it's a slow, steady concentration that has been happening for decades. The pandemic accelerated it slightly, but it didn't reinvent the wheel. The bottom 50% still hold a tiny fraction of the wealth, and that ratio hasn't changed much. The phrase biggest transfer sounds dramatic, but the actual mechanism is boring. Asset owners benefited from rising markets, and rising markets were fueled in part by the government's own borrowing. It's not a heist. It's a consequence of the incentive structure. But there is something interesting happening beneath the surface. Households with below median incomes are now putting money into investment accounts at 5 times the rate they did between 2010 and 2015. That sounds encouraging, and in some ways it is. More people are participating in the market. But the catch is that they're starting from a much lower base. The median equity holdings for stock-owning households rose from about $117,000 in the fourth quarter of 2019 to $262,000 by the third quarter of 2025. That's a big jump, but if you're just starting to invest with a few $100s a month, you're not catching up. You're getting a toehold while the top 10% are riding the feedback loop we just described. The gap isn't closing, it's widening, and the government's interest payments are one of the engines widening it. The people who already have millions are getting millions more in interest income, reinvesting it, and compounding their advantage. The people who are just starting are swimming against a current that's getting stronger every day, and the machines are making it even more mechanical. Let's talk about algorithms. You've heard that machines dominate trading, but here's what that actually means in practice. These algorithms don't just look at price charts. They use natural language processing to scan news headlines, earnings call transcripts, and Federal Reserve statements in milliseconds. They can pick up a sentence about inflation or a trade deal faster than you can finish reading it. But here's the crucial distinction. They don't understand any of it. They don't know that a war is tragic or that a trade deal is fragile. They just pattern match keywords and execute trades. When a headline says, unemployment ticked up, but less than feared, the machine sees less bad than expected and buys. That's how you get rallies on news that sounds terrible. The market isn't reacting to reality, it's reacting to a machine's shallow interpretation of reality. Now, you might think this algorithmic activity is just noise, but it has a structural impact. Because these machines are programmed to follow trends, they amplify moves. When the largest stocks are already rising, algorithms pile on, buying more of the same giants. This creates a self-reinforcing cycle that doesn't exist for smaller companies. The machines don't care about valuation or earnings quality. They care about momentum. And momentum is concentrated in the same few stocks that dominate the index. But the bigger force is passive investing. You already know that the index is weighted by market cap, so the largest companies get the biggest share of every new dollar. This creates mechanical buying pressure that is independent of any company's performance. The more money flows into passive funds, the more those top stocks are bid up, regardless of their earnings. It's a spiral that has no natural off switch. And here's the uncomfortable truth. The market is now pricing in a future that may not materialize. Look at the earnings weight gap. The top 10 companies in the index represent about 41% of the total weight, but they contribute only about 32% of the earnings. That means investors are paying a premium for the belief that these giants will grow their profits faster than the rest of the economy. They're betting that NVIDIA will keep selling chips, that Microsoft will keep selling cloud services, that Apple will keep selling iPhones. But what about the other 490 stocks? They contribute a larger share of earnings than they get in index weight. The market is systematically undervaluing the rest of the economy relative to the giants. That's not a sign of rational pricing. It's a sign of mechanical herding. Consider how these two forces interact. Algorithms detect momentum and buy the largest stocks. Passive funds automatically allocate more capital to those same stocks. Together, they reinforce each other, inflating the top of the index regardless of the underlying economy. This is not a market that rewards good analysis. It's a market that rewards size. The bigger a company gets, the more it attracts capital and the more it grows. This is the opposite of the efficient market hypothesis. It's a mechanical concentration spiral that has no natural break. And the earnings weight gap confirms that this is not about fundamentals. The top 10 stocks are valued at a premium that their earnings don't justify. You're paying for the hope that they will dominate tomorrow, not for what they earn today. That's a bet on future monopoly power, and it's a bet that widens inequality by design. Because when those profits do come, they enrich the people who already own the shares. The people who don't own those shares get nothing. The structure of the market is not neutral. It's actively concentrating wealth into the hands of the few. So if the system is rigged toward concentration, what does that mean for the average person trying to retire? You've been handed the standard playbook. Max out your 401k, buy an index fund, and wait until you're 65. That advice has been the foundation of retirement planning for decades, but it was built for a market that looked very different. When the entire index is riding on a handful of companies, the old rules don't hold. If those giants stumble, your retirement account stumbles with them. The diversification you thought you had is an illusion. The index fund you were told was safe is actually a concentrated bet on a few tech stocks. And the people who gave you that advice, they're not malicious. They're just repeating formulas that worked in a different era before concentration spirals and mechanical flows took over. The 4% withdrawal rule is another piece of advice that assumes a stable, broad market. It was based on historical data from the late 20th century when the index was more evenly spread. But in today's market, concentration changes the math. If you start withdrawing right before a downturn, the sequence of returns risk is magnified. The top stocks carry so much weight that a drop in a few companies can devastate the entire index. The 4% rule doesn't account for that. It assumes the market will recover quickly, but if the giants are the ones falling, the recovery might not come as fast. The small investor is told to follow a rule that was designed for a scenario that no longer exists, and the advice givers don't know what else to say. Here's the part that never makes it into a retirement calculator. The market structure is not neutral. It's actively working against the small investor. The very machines and passive flows that drive the index higher also amplify the downside when sentiment turns. You're told to stay the course, but the course is being steered by forces that have nothing to do with your personal financial plan. The advice you've been given assumes a level playing field. It's not level. The goalposts move every time a record high is set, and the people who set the rules are the ones who own the assets. So what do? You can't fight the machine. But you can build a framework that doesn't depend on the machine's charity. I built a digital book called The Exit Code because I got tired of watching people follow advice designed for a market that no longer exists. It's an analysis of 50 years of retirement data distilled into a mathematical framework. 2 elements from it connect directly to this conversation. The dynamic withdrawal method replaces the fixed 4% rule with a system that adjusts based on actual market conditions. It tells you how much to take out when the market is up and how much to cut back when it's down, so you don't drain your portfolio during a bad sequence. The lazy portfolio has historically outperformed active traders over 30-year windows because it doesn't fight the mechanical flows. It rides the concentration, but with a safety valve. You can get it for less than 1 hour with a mediocre financial advisor through the link in the description. This is not a magic pill. It's a framework built on data, not hope. So what does this mean for your own plan? The math is clear. You need a framework that accounts for concentration, not just diversification. The old advice assumed the market would always revert to a broad average. But when the average is being pulled higher by a concentrated group, you have to model the risk of that group breaking. You need to know how much of your portfolio is tied to the fortunes of those few companies. If you're serious about understanding the machinery, subscribe. We'll keep digging into how the entire system works, and more importantly, how to work it. But the real problem isn't math, it's your brain. And that's where the psychology kicks in. Your brain is not a spreadsheet. It's a survival machine, optimized for the savannah, not for a market where algorithms trade in milliseconds. That's not a rational response to data. It's a fear reflex that evolved to protect you from predators, not from a number on a screen. And the opposite is just as dangerous. When the market drops a few percent, your brain screams, panic, sell everything, even though the data says that staying invested through volatility has historically been the winning move. Gross domestic product grew at a 4.3% annualized pace in the third quarter of 2025. That's a strong number, objectively. But consumer confidence slipped in December of that same year. The economy is growing, but people feel worse. That's a classic brain problem. You have the data, but you feel the anxiety. And your feelings win every time. The disconnect between the numbers and your gut is not a sign that the market is wrong. It's a sign that your emotional wiring is overriding your analytical brain. The market doesn't care about your feelings. It just keeps moving. The structural concentration we've talked about makes this emotional game even harder. Your brain wants a simple narrative. Either everything is fine or everything is collapsing. But the reality is messier. The market is strong because of a narrow set of forces. And that narrowness makes it vulnerable. You feel the gap between the headlines and your own life. And that feeling is real. Your personal finances might not be improving, yet the market is climbing. That gap creates cognitive dissonance, and cognitive dissonance leads to bad decisions. You might think the market is lying to you, so you pull out. Or you might think the economy is about to collapse, so you hoard cash. Both moves are based on a feeling, not a framework. The key is to have a system that removes emotion from the equation. Not a system that predicts the future, no one can do that, but a system that tells you what to do regardless of how you feel. When the market drops 20%, your system says rebalance, not panic. When it hits a record high, your system says follow the plan, not chase the high. The data is clear. Most financial mistakes are not math problems. They are brain problems. And the only way to beat your own brain is to build a process that does not require you to think in the moment. You need to decide your strategy when you are calm, not when the market is screaming at you. So where does this leave us? The stock market at record highs is not a sign of health. It's a sign of structural shifts. It's a sign of structural shifts. And those shifts are not neutral. They're designed to funnel gains upward, and every record high is a testament to that design. The forces driving this market are not permanent. They are mechanical and self-reinforcing, but they have natural limits. When those limits are reached, the dynamics shift. Extreme concentration invites countervailing forces. The system is not static. The question is whether you are prepared for those forces when they arrive. The countervailing forces could include policy changes, regulatory shifts, or market dynamics. You do not need to predict which one will happen, but you need to have a plan that accounts for the possibility. That is what building a system means. The people who succeed are not the ones who guess the future correctly. They are the ones who build a framework that works regardless of what the future brings. The market structure is not going to change overnight. It will take years, maybe decades. But the seeds of the next shift are already being planted. The question is whether you are watching the ground or the scoreboard. The machine will keep running as long as the money keeps flowing. The question is, when the flow slows, who gets hurt? The people who understand the structure will have a plan. The people who don't will be caught off guard. That's the difference between building a system and hoping for the best. The machine is built to reward the asset-owning class. And every passive fund, every algorithm, every government interest payment is a gear in that machine. The average investor is told to ride it, but riding it without understanding the structure is like driving blindfolded on a winding road. You might get lucky for a while, but eventually the road turns. We're not calling for a crash. That would be amateur hour. But you need to understand the structure to navigate it, because the structure is the invisible hand that's been taken from your future and handing it to the algorithm. The machine is not malevolent. It is indifferent. It follows the rules programmed into it. Those rules were written by people who benefit from the current structure. That is not a conspiracy. It is a design flaw disguised as a feature. The structure itself is a system of incentives. The people who wrote the rules built them to protect their own positions. That does not make them evil. It makes them rational. But if you follow the same rules without understanding them, you are playing a game you cannot win. The point is not to hate the machine. The point is to learn its language. Once you understand how the incentives flow, you can position yourself to benefit from them rather than being crushed by them. Instead of fighting the current, you can learn to ride it. The difference between a victim of the system and a beneficiary of the system is awareness. The system does not care about your intentions. It only responds to leverage. The people who understand the leverage are the ones who come out ahead. The people who do not understand it are the ones who get left behind. That is the structural reality of the market. Lazy investing built more fortune than crypto memes. The real problem isn't that stocks are high. It's that most people don't own enough of them to matter. Build a system that works for you, not for the machine. Who do not understand it are the ones who get left behind. That is the structural reality of the market. Lazy investing built more fortune than crypto memes. The real problem isn't that stocks are high. It's that most people don't own enough of them to matter. Build a system that works for you, not for the machine.